your tax needs and more. Later CPA is the one you adore. Later CPA and Associates, accounting done great by mates. Later CPA and Associates, accounting done great by mates. For all your tax needs and more, later CPA is the one you adore. Later CPA and Associates, accounting done great by mates. For all your tax.
Hi there, I'm Daniel Later, founder of Later CPA and Associates, and welcome back to our ongoing series about building a successful private practice from beginning to infinity. I told my client I'd save them thousands with tax planning. They said, "Wow, really?" I said, "Yeah, mostly in aspirin from not stressing every April." All right, let's go ahead and jump right into it. Another one of our advanced tax strategies. We're at that point where we're talking about these things. So this week, we will be talking about advanced depreciation strategies you can use for your office. So do you ever feel like your equipment and your office upgrades should be doing more for you around tax time? Well, depreciation is one of the most powerful tools in a business owner's tax strategy, especially when you know how to go beyond the basics. So the goal today is to help private practice owners understand advanced depreciation methods that can accelerate their deductions, improve their cash flow, and optimize long-term tax efficiency. So let's jump right in. So why does this topic matter? Well, therapists, especially with your own physical office, invest heavily in your office furnishings, computers, possibly other equipment that you might need, your comfortable chair, etc. All of these, or using advanced depreciation options, can help create larger deductions earlier for purchasing these items, and it helps to improve your liquidity. Now, strategic use of depreciation can help to offset income spikes or prepare when your S corporation has payroll adjustments. It's another tool in the tool belt, depreciation. So a couple of points we want to cover. We're going to talk about first, Section 179 expensing or depreciation. This is not the same as bonus depreciation, which has been in the news a lot over the past several months. Section 179 is still a great one. So Section 179 allows you to immediately deduct any qualifying property or assets you buy, rather than depreciating them over several years. And this is great for large purchases, your furniture, your computer, any other equipment you might need. Any physical assets. The limits for 2025 are up to 2.5 million. 2026, it goes up just a hair more than that. But these assets you buy, they need to be purchased and placed in service during the tax year. Not just bought on December 31st, placed in service January 1st. Unfortunately, that's a trap that catches a lot of people. Don't do that. It has to be bought and placed in service in the same year, the year you're affecting. Now, Section 179, it's a great one. There's some drawbacks. We won't get into the details or the minutia to make this video too long. It can be used together with bonus depreciation to give you more flexibility, but Section 179 depreciation, it cannot push your net income below zero and create a loss. That's one big limitation to be aware of. You can't go past zero net income. You can't go lower than that. So that's Section 179. It's complicated. If you have questions, talk with your tax preparer. They can lay out more of the details. It's a tool in your depreciation tool belt. Another one, a big one, it's been in the news a lot ever since the new tax bill came out, bonus depreciation. Now, this has some similarities with Section 179 and some differences too. We're just going to hit the main points. You'll see a lot of similarities there. Bonus depreciation allows you to immediately deduct and write off 100% of any qualifying assets you buy. Now, this was a different percentage. It was lower. The new tax bill in July pushed it back up to 100% where it was years ago in the past. Now, again, these assets, need to be placed in service in the year, bought and placed in service in the year you buy them. This applies to both new and used assets you buy, as long as it's new to you. You can't repurpose an old desk you've had in your basement for years and now it's in your physical office and call that and use bonus depreciation on that. It won't work. Now, again, there's a lot of similarities between Section 179 and bonus depreciation. I'm not going to go into the details, the minutia of the differences, but talk with your tax preparer, your tax advisor, about which to use or what combination of the two to use, bonus or Section 179. The differences are small but significant, but both are good tools to have, allowing you to take more or potentially all of the depreciation from an asset you bought in the year you bought it, instead of taking that depreciation slowly over 5 or 7 or 15 years. Now, there's another option we have for those private practice owners who own their office. Not just rent it, but actually own the physical building where your office is at. There's a tool called a cost segregation. If you have any people who invest in real estate, ask them about this. They'll tell you loads and loads about it too. But a cost segregation basically takes every part, every piece of your building, separates into its pieces and parts, and then allows you to depreciate those pieces and parts over whatever their natural life is, instead of taking the entire building and depreciating it over 39 years of time. So to illustrate that, imagine you buy an office building for $1 million. Great. Perfect. That $1 million will create a depreciation deduction split over 39 years evenly. So $1 million divided by 39 years tells you how much you can take every single year. And that would be nice to have over 40 years, unless you really, really need to take more sooner. Then you do a cost segregation. You'll have a specialist come and look at the building and on paper, take the whole thing apart and start looking at the individual pieces, the windows, the door frames, the electronics, or the wiring, the flooring, everything, every piece that's normally attached. They'll look at it separately and say, okay, all of these pieces are 5-year depreciation. Instead of taking those pieces over 39 years, you could take them over 5 years. Get your depreciation deduction a lot faster. These pieces are 7 years or 15 years, and you can take them a lot faster than 39 years. That's essentially how a cost segregation works, looking at items broken apart. A cost segregation is a fantastic tool if you own the property, the building. It lets you accelerate all those deductions. Now, it is not a good idea if you want to keep that depreciation number steady over that long period of time. It's a conversation to have with your tax professional on what would be better for you. Now, a couple other items. We talked about depreciation for larger things, furniture, computers, any other equipment. But there is we call it a de minimis or a safe harbor number, where if you buy something, if you buy anything, any individual one thing, and it costs less than $2,500, $2,500, if it's less than that, you don't have to worry about depreciation. Just deduct it all immediately. It's called the de minimis safe harbor election. It applies to anything. You buy a computer, less than 2,500. Great. You buy office furniture, less than 2,500 for each piece. Great. It applies to that. You buy a new desk, less than 2,500. Great. You buy a really, really nice desk, more than 2,500. Sorry, it cannot use the de minimis safe harbor. You have to use the other depreciation strategies we talked about. But it's a nice way to basically not try and track every little thing you bought. Now, when we look at depreciation and how to use it for tax planning, we're looking at the time frame and how much or how little we want to take depreciation in any given year. If you're in a year where you have a very low tax rate, just for kicks and giggles, let's say you're in the 10% tax rate, the lowest federal tax rate. Fine, that's great. You won't want to take $100,000 of depreciation accelerated into that 10% year. It just doesn't make sense. You would want to take as little depreciation in a low tax year. Just pay the low tax rate, but save that depreciation, that potential depreciation expense for a year where you have a high tax rate. This is how we time and plan depreciation expenses to benefit you. If you're in a year where somehow you fall into one of the top tax rates, let's say you're at 37% federal income tax rate, that's a big one. If you've got $100,000 of potential depreciation expense you can accelerate to that year, do it. That will save you about $37,000 in taxes right there. So keep that in mind. It's all about timing and planning and preparing to take depreciation when you're able to. Now, we cannot look at depreciation in a vacuum. It doesn't work like that. There's all kinds of other things going on at the same time. We also have our payroll. Maybe we're growing our firm and we have a lot more expenses, lower income, but we're massively growing. Or maybe we're in the steady state where now everything's set up. Now we're just going to really capitalize, really improve our cash flow to make the business pay us and reward us for our hard efforts. Maybe you're in that situation. Maybe you're in the situation Maybe you're in the situation where you're making massive or large retirement contributions for you and your employees. Whatever. Those are all things to consider along with your depreciation. We don't look at depreciation or any particular one item in a vacuum. We look at them combined together to see how they all work together in a whole. So, just to recap what we talked about, using advanced depreciation strategies, it lets you accelerate future depreciation expenses, taking them now to reduce now's taxable income. It gives you a little bit more flexibility in managing how your long-term income is being smoothed out. And it gives you opportunities to align your capital investment with your tax strategy. So a couple tips. Maintain good records. You buy something big, you keep the receipt or the invoice for it somewhere. It's easier to know what it is later on. Work with your CPA or your tax professional to determine what depreciation option is going to work best for you, short-term and long-term. And your tax preparer will help you with this, but put together a depreciation schedule for the future so you know what every year of depreciation might look like for you. A couple closing thoughts. Depreciation is not just another accounting entry. It's a planning opportunity. With smart timing and the right elections, your office furniture, computers, and other equipment can end up paying you back a lot more at tax time. So think about this. What upcoming equipment or office improvements or purchases could you strategically make to maximize your deductions for the next tax season? It's weighing the question of, do I need this now or do I need this next year or in the future? Now, if you've got any questions about this topic, depreciation is a complicated one. So if you've got any questions, feel free to reach out, DM me, message me, whatever. I'm happy to answer any questions. If you would like to schedule a free 30-minute discovery call with someone at my firm, most likely myself, go ahead and DM me. We'll send you a calendar link. We'll get you on the schedule, and we'll talk to you about the business, about the tax strategy for your business and your personal tax situation. We'll look at them together. Follow, subscribe, like, and keep tuned for future tax tips that we give, or any future event notifications like this one. And visit our website, latercpa.com. I'll see you on the next video. Have a great weekend, and keep helping others to help themselves, and let us help you so you can do just that. Bye.
For all your tax needs and more, Later CPA's the one you adore. Later CPA and Associates, accounting done great by mates. For all your tax needs and more, Later